NextEra Energy just dropped Q1 2026 results, and the stock surged 7% in a single session. Something big is happening inside this clean energy giant, and we are here to unpack every number.
When America's largest renewable energy company beats earnings expectations and reaffirms its long-term growth target, institutional investors take serious notice. The clean energy story is decisively back in focus for 2026.
Welcome to Charged Alpha. Today we are going deep on NextEra Energy, ticker NEE, trading on the NYSE, the Florida-based utility that became the world's largest generator of wind and solar power.
NextEra Energy traces its roots to 1925 when Florida Power and Light was established to bring reliable electricity to the rapidly developing Sunshine State during the post-World War I economic expansion.
For nearly 7 decades, the company operated as a conventional regulated electric utility, running coal and natural gas plants and steadily extending the Florida transmission and distribution network.
The transformation began in earnest in the early 1990s when FPL Group made a bold and early bet on wind energy, long before renewable power was economically competitive or politically supported.
By the early 2000s, the company had become a serious player in competitive wholesale electricity markets across North America, building what would eventually become the world's largest portfolio of clean energy assets.
In 2010, the company rebranded from FPL Group to NextEra Energy to explicitly signal its strategic identity as a clean energy leader and growth utility. The name change was a declaration of intent.
Today, NextEra sits at the intersection of 2 massive secular trends: the electrification of the entire economy and the urgent global shift toward decarbonization. Few companies are better positioned for both simultaneously.
John Ketchum has led NextEra as chairman, president, and CEO since March 2022. He succeeded the long-serving Jim Robo and came up through the finance function, serving as CFO before taking the top position.
Ketchum's financial background makes him ideal for this phase of the company's story. Managing a 300-plus gigawatt pipeline across North America requires extraordinary capital allocation discipline and risk management sophistication.
His key strategic priorities include expanding the renewable development backlog, capturing AI-driven data center electricity demand in Florida, deploying battery storage at scale, and maintaining that 6 to 8% EPS growth commitment.
Before Ketchum took the helm, Jim Robo had spent more than a decade building NextEra's clean energy leadership position. Ketchum was Robo's CFO and deeply involved in every major strategic move during that transformational era.
That leadership continuity matters enormously in a capital-intensive business where development cycles span years and regulatory relationships with state utility commissions span decades of institutional trust building.
The battery storage initiative deserves special attention. Pairing gigawatt-scale storage with solar and wind farms dramatically increases the dispatchability and market value of those intermittent assets in competitive power markets.
Now let us walk through 8 quarters of revenue history to understand the trajectory. In Q2 to 2024, NextEra posted $6,069 million in revenue, establishing the baseline for the most recent growth cycle.
Q3 2024 surged to $7,567 million. Florida summer peak electricity demand, plus strong wind resource across the Great Plains, drove that powerful seasonal acceleration in revenues.
Q4 2024 pulled back to $5,385 million. Winter quarters are typically softer for this asset mix, with lower air conditioning load in Florida and reduced solar irradiance across the national fleet.
Q1 2025 recovered to $6,247 million. That number is the critical year-ago comparison point. We will come back to it when we assess what just happened in the most recent quarter.
Q2 2025 held steady at $6,700 million. The Florida regulated utility base was growing, and the renewables segment was executing on its contracted pipeline throughout the middle quarters of last year.
Q3 2025 spiked to $7,966 million, a record quarterly result. Record summer temperatures across Florida, combined with full deployment of new contracted renewable capacity, drove that exceptional number.
Q4 2025 settled back to $6,563 million. The full year 2025 showed consistent sequential momentum, building an elevated baseline heading into this fiscal year's results.
And then Q1 in 2026 printed at $6,701 million. That represents revenue growth of 7.3% year over year versus the prior year, Q1 of $6,247 million.
Revenue technically missed the analyst consensus estimate of $7.2 billion by roughly $564 million, but earnings per share told a completely different and substantially better story.
Adjusted EPS for Q1 2026 came in at $1.09. The Wall Street consensus was $1.03. That is a 6-cent beat on an annualized base, approaching $4.40 in forward estimates.
GAAP diluted EPS was $1.05. The operating leverage embedded in NextEra's contracted portfolio means EPS can beat meaningfully even when revenue is slightly below expectations on weather or timing.
Looking at recent EPS history for context, Q3 2025 posted $1.13 versus estimates of 97 cents, a 16-cent beat that reset expectations higher. Q4 2025 came in at 53 cents, slightly below the 56-cent estimate.
The Q1 2026 result at 109 beating 103 establishes that the earnings growth trajectory is fully intact. Management reaffirmed the annual guidance range on the earnings call with no downward revision.
Let me walk you through the forward EPS projection that anchors the entire long-term thesis. Full year 2026 analyst consensus is $4.39 per share, a meaningful step up from recent annual results.
FY 2027 estimates reach $4.77, roughly 9% growth over 2026, and FY 2028 projections land at $5.12. 3 years of compounding EPS visibility from contracted assets.
That second forward EPS projection data point, the FY 2028 estimate of $5.12, represents cumulative EPS growth of approximately 16% from today's base. Few utilities can show that kind of visibility. These forward estimates are not aspirational. They are underwritten by long-term power purchase agreements signed before construction begins on each project. The contracted nature of the backlog is NEE's defining competitive advantage.
Now for margins. NextEra's trailing 12-month gross margin sits at approximately 48%. Solar and wind assets have near zero variable operating costs once constructed, driving exceptional incremental profitability.
Operating margin on a TTM basis was approximately 29.5%. Compare that to Duke Energy at roughly 18% and American Electric Power at around 15%. The quality differential is stark.
Net margin runs approximately 29% on a trailing basis. The combination of stable regulated returns from FPL plus high-return contracted renewables through the resources segment produces this industry-leading profitability profile.
Q1 2026 operating income was $2,208 million on revenue of $6,701 million. That operating margin of nearly 33% reflects the earnings power of the contracted portfolio.
EBITDA for Q1 2026 was $1,283 million. The depreciation and amortization charges of $1,371 million reflect the enormous capital base deployed across generation and transmission assets.
Now let us look at cash flow. Q1 2026 operating cash flow was $2,614 million, a strong start to the fiscal year and confirmation of the earnings quality behind the reported results.
For quarterly context, Q3 2025 generated $4,028 million in operating cash flow at the seasonal peak. Q4 2025 was $2,499 million. Q2 2025 produced $3,189 million.
Free cash flow in Q1 2026 equaled operating cash flow at $2.6 billion. The CapEx line flows through the investing section of the cash flow statement, where NextEra deploys its massive multi-billion annual capital program.
Full year 2025 capital expenditure was approximately $9 billion. NextEra routinely spends more than its operating cash flow in any given period, funding the gap through carefully structured long-term debt issuances.
The CapEx intensity is entirely deliberate. Every project that gets built has a contracted buyer under a 20-year power purchase agreement. You are essentially pre-selling the output before you break ground.
That contracted revenue model fundamentally de-risks the capital deployment. Unlike merchant power companies that bet on spot electricity prices, NextEra locks in the return before committing the first dollar of capital.
Turning to the balance sheet, cash and equivalents at quarter end stood at $1,998 million. Short-term debt was $10,455 million, the current portion of the financing structure.
Total assets are a staggering $221 billion. This reflects a century of utility investment, generation plants, transmission infrastructure, distribution networks, wind farms, and solar installations across North America.
Total equity, including minority interest, stands at $66,632 million. That minority interest reflects the partnership and tax equity structures NextEra uses to finance many of its renewable projects.
Net debt at quarter end is approximately $8,457 million on the current balance sheet. On a full enterprise basis, including long-term obligations, the leverage picture is more substantial.
Debt to EBITDA on a trailing basis runs approximately 5.7 times. This is standard for a regulated utility with predictable cash flows, but it is a meaningful constraint on financial flexibility.
The regulatory compact that governs FPL is crucial here. Florida's Public Service Commission allows NextEra to pass financing costs through to regulated electricity rates, which partly insulates the business from rate increases.
That regulatory cost recovery mechanism is why utility investors accept higher leverage ratios than they would for industrial companies. The cash flows supporting that debt are embedded in state-sanctioned rate structures.
Interest expense was $1,287 million in Q1 2026 alone. Interest coverage at 5.4 times is adequate, but highlights why rising interest rates are such a significant sensitivity factor for NextEra.
On capital returns, NextEra pays an annual dividend of $2.32 per share. At the current stock price of $96.25, that produces a dividend yield of approximately 2.4%.
The payout ratio is approximately 59%. That leaves substantial retained earnings to fund capital investment while still growing the dividend. The 10% annual dividend growth track record is one of the best in the utility sector. The dividend growth record speaks for itself, 10% annual increases for over a decade, backed by a payout ratio well below 100%. This is what sustainable income investing looks like for a utility.
No share buybacks at NextEra, and that is an explicit strategic choice. Management consistently argues that deploying capital into contracted renewable projects generates higher risk-adjusted returns than repurchasing shares at current multiples.
18 analysts currently cover NextEra Energy with active ratings. 13 carry buy or overweight designations. 4 are at hold. A single analyst holds a sell rating, indicating the overwhelming consensus is constructive.
Morgan Stanley maintains overweight, saying the clean energy growth narrative remains fully intact. UBS is at buy, specifically citing the renewable development pipeline and accelerating data center electricity demand in the Florida service territory.
JP Morgan maintains overweight, reinforced by today's Q1 EPS beat and the confidence that the annual guidance range will be achieved. BMO Capital holds outperform while monitoring the next Florida Power and Light rate case filing.
Wells Fargo maintains overweight on the clean energy platform thesis. Barclays stays at equal weight, expressing ongoing measured caution about the sensitivity of utility valuations to interest rate movements.
The average analyst price target is around $88, which ironically now sits below the current market price of $96.25 following today's strong rally. The street is behind the move.
Price target range spans from $72 at the most cautious end to $110 from the most bullish analyst. Reaching that upper target would imply approximately 14% additional upside from here.
On valuation, NextEra trades at 24 times trailing earnings. That is a significant premium to the utility sector average of around 18 times. The market has consistently awarded this premium for NextEra's superior growth.
Price to sales is 7.2 times trailing revenue, very elevated for any utility. EV to EBITDA is approximately 14.4 times. Price to book is 3.6 times. These multiples demand growth delivery.
Looking at NextEra's rivals in the utility sector, Duke Energy is the closest competitor at roughly $100 billion in market cap. Duke serves the Carolinas and Midwest with a primarily regulated portfolio.
Duke trades at 12.8 times EV to EBITDA, about a two-turn discount to NextEra. The rivals comparison shows Duke growing earnings at 3 to 4% annually versus NEE's 6 to 8% target.
Southern Company, at $105 billion in market cap, operates regulated utilities in Georgia and Alabama. Their now complete Vogtle nuclear expansion cost massively more than projected, but delivers valuable zero-carbon baseload generation.
Southern trades at 13.5 times EV to EBITDA. Its nuclear expertise differentiates the business, but the growth rate still trails NextEra's pipeline-driven earnings compounding. Southern offers a higher dividend yield, though.
American Electric Power, at $73 billion, is the cheapest major rivals peer at 11.2 times EV to EBITDA. AEP is heavily regulated, serving 11 states with significant infrastructure investment programs.
AEP's coal legacy creates transition costs and near-term earnings headwinds. The significant valuation discount is warranted versus NextEra, given the growth differential and the complexity of the energy transition underway.
Xcel Energy rounds out the comparison at $50 billion in market cap, trading at 11.8 times EV to EBITDA. Xcel is an underrated clean energy utility but lacks the scale and the contracted pipeline that drives NEE's premium.
The two primary business segments define the investment case. Florida Power and Light, roughly 55% of revenue, is the regulated franchise serving 11 million Floridians across the eastern and western coasts of the state.
NextEra Energy Resources, roughly 40% of revenue, is the competitive clean energy development arm. This segment houses the wind, solar, nuclear, and battery storage portfolio under long-term contracted power purchase agreements.
The Florida growth story is extraordinary. AI computing infrastructure demands enormous electricity. Data center construction across Florida has accelerated dramatically, creating load growth for FPL not seen since the post-war population boom.
6 key catalysts define the bull thesis. Accelerating data center electricity demand in Florida, the massive 300-plus gigawatt contracted renewable pipeline, battery storage scaling rapidly at gigawatt levels throughout the network.
The Florida Power and Light regulatory framework supports earnings growth through rate case approvals. Nuclear license extensions preserve low-cost clean baseload generation, and Inflation Reduction Act tax credits enhance returns across the entire new build pipeline.
6 primary risks deserve attention. Rising interest rates increase financing costs and compress utility equity multiples. Tax incentive modifications could impact project economics significantly. Weather events, including hurricanes, hit the Florida franchise hard.
Supply chain constraints for wind turbines and solar panels create execution risk on new project timelines. Competitive pressures in renewable power purchase agreement pricing could compress returns on new capacity. Balance sheet leverage remains elevated throughout.
The bull case is straightforward. NextEra is the best-positioned utility in the world for the energy transition. The combination of regulated cash flows, contracted renewables, and the unmatched pipeline creates a uniquely durable earnings compounder.
The bear case centers on valuation compression risk. At 24 times earnings with a 2.4% yield, if the Federal Reserve keeps rates elevated or the economy slows sharply, utility multiples contract and NEE falls with them.
But the counter to that bear argument is that the contracted revenue model provides a floor that pure-play growth stocks lack entirely. Even in a rate shock scenario, the 20-year PPAs keep cash flowing and dividends growing.
Sheikh Ahmed Zaki Yamani once observed, "The Stone Age did not end because we ran out of stones. We left the Stone Age because we found something better." NextEra Energy is relentlessly building that something better every quarter.
With Q1 2026 earnings beating estimates, full-year EPS guidance reaffirmed, the renewable pipeline growing, and Florida's electricity demand accelerating, the investment thesis for NextEra Energy remains as compelling as it has ever been.
Q1 2026 adjusted EPS of $1.09 versus the $1.03 estimate is not a marginal beat. Revenue of $6.7 billion beating $6.5 billion. Consensus confirms the operational thesis is executing as promised.
Management reaffirmed the full-year 2026 adjusted EPS guidance range of $3.85 to $4 per share. That midpoint implies approximately 9% earnings growth year over year, consistent with the 10-year compounding track record.
Guidance reaffirmation after a Q1 beat signals management confidence in the seasonally stronger back half. Florida's summers drive peak electricity demand, and the summer of 2026 will be the first to fully reflect data center load additions from the prior 18 months.
The balance sheet funding model deserves one more point. NextEra combines operating cash flow, project finance debt, tax equity partnerships, and investment-grade credit facilities to sustain its capital program without diluting common equity holders.
JP Morgan noted the Q1 print positions NextEra to raise the bottom end of full-year guidance following Q2. A strong Florida summer and any favorable regulatory development on the next FPL rate case would be the catalysts that move the stock.
NextEra has compounded adjusted EPS at nearly 10% per year for the past decade, while growing the dividend at a similar rate. The Q1 beat reinforces that this record of execution continues intact under CEO John Ketchum and his leadership team. 13 buy ratings, 4 holds, 1 sell. That analyst distribution tells you the institutional community is broadly aligned with the bull thesis. The skeptics are outnumbered by more than 10 to 1 right now.
For investors who believe in the clean energy transition, in the electrification of transportation and computing, and in the durability of 20-year contracted revenues, NextEra Energy belongs on the watch list and the portfolio.
This podcast is for informational and entertainment purposes only and does not constitute financial advice. The information presented reflects data available at the time of recording and may not be current. Always consult a qualified financial advisor before making any investment decisions. Charged Alpha and its hosts may hold positions in securities discussed. Past performance is not indicative of future results.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.